Hello, I'm Michael Taila, Director of Fixed Income at City National Rochdale, and welcome to this month's edition of Fixed Income Perspectives. July was a strong month for bonds. Lower inflation readings and expected rate cuts around the corner combined to send Treasury yields lower and returns higher. Looking across asset classes, Treasury and corporate bond markets returned 2.2 and 2.4%, the largest monthly returns for the year. After a challenging year for the tax-exempt market, investment-grade municipals returned just under 1% for the month, bringing the asset class into positive territory for the year. High-yield sectors of the market added to already strong performance, with U.S. high-yield corporate bonds up 4.6% and high-yield municipal bonds up 5.3% year-to-date. It's notable that even during periods of increased equity volatility, credit spreads remain low and default rates are starting to trend lower, offering further support for the asset class. The Fed left rates unchanged at the July 31st FOMC meeting, but signaled that rate cuts may be appropriate as soon as September. With rates already moving down after the FOMC meeting, the start to August has brought elevated volatility with major movement in yields across the market. A decline in July payroll data and an increase in unemployment of 4.3%, on top of weaker than expected manufacturing data, sparked a decline in yields. Technical factors, which emerged from the unwind of the Japanese carry trade, also applied downward force on the level of yields. 2- and 10-year Treasury yields declined by 34 and 24 basis points respectively. However, as of the time of this recording, the Treasury market has retraced much of the decline as the concerns over the unwind of the carry trade have eased, and incoming economic data suggests the labor market remains on solid footing. It's important not to overreact to one data point. While the recent moves have been sharp, the economy is still growing and is transitioning back to its normal pace. We believe the markets are too aggressive with respect to expectations for rate cuts, and we continue to expect the Fed to take a measured approach with 1 to 2 rate cuts this year, although we do acknowledge that the probability of 3 cuts is higher. Additionally, we believe rates have peaked, but we expect the 10-year to be range-bound between 4 to 4.5% for the remainder of the year, as technical pressure from supply will keep rates elevated. Finally, the recent market swings are a great reminder that long-term bonds may prove beneficial as the Fed begins its easing cycle and short-term yields begin to decline. Thank you for joining me today for the Fixed Income Update.